Hello everyone, give me a couple of minutes, I will do a reminders about that lecture. I just totally forgot to send reminders on the messaging apps. Let's see. One on Messenger. One on Telegram. And one on email. Is sound okay? Is everything okay? Do you hear me well? Sorry for these administrative matters. Okay, so hopefully we are good to go. Let's go check our schedule here. So today's topic is cash flow, statements of cash flow. We will start with MIT materials. Then we move to PwC finance financial statements preparation guide. Okay, that one seems to work now. Okay, and let's see. Okay, here is the chart. So we will start with MIT materials. Then we will move to PwC FS guide, page 88. Financial statements presentation guide. And we will end the lecture with a practice of cash flow preparation. So let's move to materials. Statements of cash flow. Statement of cash flow is one of the financial statements. It is as important as balance sheet and income statement, and its role is to show how much cash movements, so where your cash came from and where did your cash go. Provides an important information to investors and creditors. Information about differences in the timing of revenue and expense recognition under GAAP and the associated cash inflows and outflows. So there might be situations in your business when you generate revenue and you have a profit, but it is like a paper profit. For example, you are selling some goods on a generous payment terms. You give like 30 day payment delay, 60-day payment delay, or even more. So you kind of generated a lot of revenues and profits, but you ran out of cash. You ran out of cash because all of your revenues, they are still accounts receivable and they didn't transform into cash. And to reconcile such differences, you present in your financials the statements of cash flow. Let's see what they say here. In your statements of cash flow, you will break down your cash flow into 3 categories: operating cash flow, investing cash flow, financing cash flow. The statement sums to the actual change in cash during the year. The change equals the difference between the beginning and ending cash balances. Let's look at an interesting example. AMC sec filings. So AMC is a cinema theater chain, and it was known for bad business decisions. It was almost bankrupt pre-COVID, and COVID made things even worse. But AMC was able to survive that, and that's a pretty remarkable case. So if we go to their financial statements, that's their annual filings for 2020. Let's see, where do we have selected financial data? Financial statements, item 8. So that's where the importance of the cash flow will show up. So in their income statements, as you see, they have 5 billion revenues, 5.5 billion revenues in 2019. And in 2020, they only have 1.2 billion revenues. And all of that translated into huge loss, almost 5 billion of losses. But you might also note that on that side, they have 2.5 billion of impairment of long-lived assets, definite and indefinite-lived intangible assets, and goodwill. So basically, a big chunk, more than half of that loss, is just impairment of whatever we spent our money on couple over the history of the company. So it's not a cash loss. So if we move to a statement of cash flows. So if we go to the balance sheet, you will see you have goodwill here and intangible assets. And you have like a 5 billion of that, and then you have 2.7 billion of that. That's where impairment happened. So we have like a 5 billion of losses, 4.6 billion of losses. But let's look at the cash flows. And here it is, a cash flow. And operating activities cash flow. It is only 1.1 cash outflow for that year compared to 5 billion loss. So from cash flow perspective, things weren't that bad for an IMC. So they also have some investing cash outflows, because to maintain their business running, they have to renovate the cinemas, they have to make some capital expenditures, but they kind of fastened their belts and they didn't spend much on that. And then there is a financing activities. So financing activities are the ones which are related with your attraction and repayment of capital. Loans, it's your relationships with the banks for loans received and repaid, and it's also your relationship with owners of the company. So dividends, purchase, buybacks of stocks, and all of that. And as you can see, they've managed to issue quite a bit of different notes and borrowings, and they attracted that 1 billion of capital, and they were able to survive despite their like 5 billion of losses. And if you take a look at their equity, stockholders equity, they actually got a negative stockholders equity. In normal world, they would have been bankrupt already with such equity, but in United States, in zero interest rate environment, they were able to survive. And the Wall Street bets happened, and their stock price blow up, and they basically issued some extra shares. They got some cash to run for another couple of years, and by that time maybe the demand for cinemas will go back to normal, and they will be able to survive. Okay, let's go further into our MIT lectures. So here are three things: cash flows. Operating relates to your operations. Investing relates to your acquisition of assets and disposal of assets. And financing cash flow relates to your acquisition of capital and your repayment of capital. The statement sums up the actual change in cash during the year. The change equals the difference between the beginning and the ending cash balances reported on the balance sheet. So let's go back to AMC. So here, let me add a bit of zoom. At the end of your cash flow, you calculate your net increase, decrease in cash and cash equivalents and restricted cash. And then you have cash and cash equivalents at the beginning of the period. And then you have cash and cash equivalents at the end of the period. So we have 45 million change, we have 275 at the beginning, and we have 321 at the end. Let's go to their balance sheet. Assets, cash and cash equivalents, restricted cash. So I would assume we sum up these two, 321 to 75, and here we have 275, 321. Yeah, so that's what is reconciled, and all your movements in cash flow should reconcile to that. We will look into more details on that in our practical session. Okay. Why would we want to focus on the cash flow statement? That's because net income is reported in income statements, and it provides important measure of performance. However, in the absence of cash flow, income does not pay the bills. So that's what AMC demonstrates. Despite their huge losses, 5 billion in losses, they were able to pay the bills because some of those losses were non-cash losses. They also have non-cash depreciation and all of this stuff. And they also managed to get some financing cash inflows from borrowings. Okay. Interest and dividend payments required principal reductions on debt, and capital expenditures for plant and equipment and for expansion cannot be made without cash. Yeah, that's what we saw with AMC. Cash provided by operating activities, also known as operating cash flow, is a primary source of cash to meet these needs. Yeah, it's a primary source, but again, with an AMC example, the cash flow from operating activities was also negative. And we got some negative capital cash flow because we need to maintain our cinemas. But we closed all the gaps with some extra borrowing. Okay, Let's take a look further. Let me see what I have on the schedule. Yeah, so we have an hour for that, and an hour for income statement guide, and an hour for practice. Okay. In the absence of operating cash flow, cash from other sources can be used to cover cash requirements. Yeah, that's what we saw with AMC. Cash can be obtained from on-hand balances or non-recurring asset sales, new debt, or equity financing. In case of AMC, it was new debt. These non-operating sources of cash flow can be relied only in the short run. That's true, so AMC won't be able to survive for long. Let's go open their most recent quarterly filing. It is third quarter 21. And balance sheet. Okay, so on the balance sheet, as you see, they have $1.6 billion on their balance sheet. And let's go take a look at the cash flow. They still generate, so for the three quarters 21, they generated $1 billion in losses. They have depreciation here, they have pay in kind, interest expense, they have a lot of non-cash stuff. And they ended up with 660 negative operating cash flow. But what happened? That actually issued quite a bit of stock. They got a new loan for 500 million, but they also issued like 2 billion of new stock, 2 billion of new equity. So that's not borrowing, that's equity, but it still shows up in the financing activities. So that helps them to survive. Okay. These non-operating sources of cash flow can be relied upon only. Yeah, they will not. So their cash burn rate is about like currently like a $200-300 million per quarter, and they have 1.5 billion in cash. So basically they have cash to survive like 5 more quarters, and if situation doesn't get better, they will be done with. Okay, let's move on. Here we have an example when we look at the entries and how they can impact cash flow. So for example, that entry, Joe Landscaping Service contributes $10,000 in cash. So it impacts cash, it impacts equity. If we go to AMC cash flow statements, that transaction would show up in the cash flow from financing activities. A quick answer before we dive deep into that. Let me see if I logged in. I had an edited document here, and hopefully it will open correctly. So just a quick note, what is the best source for details on income statement? It's accounting guide. I use PwC accounting guide for financial statements presentation. You might prefer it from someone else. There is also a separate document from KPMG. And let's scroll down to typical, how they call it, sample statement of cash flows. Let me zoom in quite a bit. Yeah, so we have a typical operating cash flows here, cash flows from investment activities, and cash flow from financing activities. And Let me take text highlighter. So we have an equity contribution. And if you look into financing activities, we will find it repayments of debt, proceeds from debt, bank overdrafts, dividends paid, net payments, repurchases of equity, acquisition, distribution to non-controlling interests. That's interesting. For some reason, they do not show issue proceeds from share issue. They have repurchases here. Is it? Yeah, financing. That's good that we have AMC example, because in AMC we can see that net proceeds from Class A common stock issuance, it's under cash flow from financing activities. So this is a financing activity. The company borrows 3,000 from the bank. So loans payable cash. Both in that guide, proceeds from debt. So here it is, proceeds from debt. In AMC case, we have proceeds from issuance of other long-term loan. So here it is under financing activities. Next one, please. Company purchases equipment for 5,000 cash. So outflow of cash and inflow of equipment. So that should go to investing activities. Acquisition, proceeds from sale of property, plant and equipment. In AMC, that would be just capital expenditures. So capital expenditure is always a financing or always an investing activity. So let's go here. Company performs services for 12,000. The customer pays 8,000 in cash and promises to pay the balance at a later day. So that's, you see, we got 8,000 cash, 4,000 in receivables, and generated 12,000 in revenues. As you might have guessed, this is where we have operating activity. And for operating activities, so our revenue will reflect in our net income here. So we have net income here. And then we also have a receivable. And for that part, the cash flow statement has some adjustments. And it is adjustments. Here we have changes in operating assets and liabilities. And it just goes cash received on, no, it's not that one. Increase in trade receivables. We will dive into details. We now just doing high level view of some transactions in here, but we will dive into more details more later. Company pays a dividend of 1,000. I'm just showing you an example how each entry is reflected on the cash flow. So dividend transaction is a transaction with providers of our capital, and our capital is provided in financing activities. So if we go here, if we go to financing activities, and we should see dividends paid here. And if we go, so IMC doesn't pay dividends, it is making losses. So not a good example here. Okay, so that's all summarization. So we have, 9,000. What was 9,000? We pay 9,000 for expenses, and we paid it with cash. So basically these, no changes in balances, this will all go through income statement. Okay. So net income is 3,000. In that situation, cash is like 6. We generated 6,000 in cash, but our net income was only 2,000. And that's mostly because we injected 10,000 in equity into our company. Okay, so we have a bit of a theory here, but before we go here, I want to come back to my working document for that lecture. And in that document, I send you the link. We actually have two methods of cash flow preparation. I need to outline that before we dive deeper into the details. There is a direct method, and two methods are different from operating cash flow perspective. So as you might remember, we have operating cash flow, investing cash flow, financing cash flow. Investing and financing cash flow will be the same regardless of the methods used to prepare. And operating cash flow preparation might be different, might be done under two different methods. And the preferred method, so accounting standards even has a preferred method for cash flow, and that's a direct method. And though it is preferred, almost no one uses it. Almost everyone uses indirect method. That's because there are quite a few differences quite a few difficulties to prepare the cash flow under the direct method. So what you see with IMC is actually indirect method preparation. But let's just say a few words about direct method of cash flow from operating activities. So under the direct method, you will have headers like cash received from customers, cash paid to suppliers, cash paid for salaries, cash paid for tax, cash paid for interest. Let's go to our homework files and let's just do it here. Cash flow and cash flow so we basically have operating, financing, and usually it's investing. And we have some under the direct method. Let's take a look. So all that big file is related to indirect method. But the parts which are let's see if I can, how can I copy it from here? Cash flow from investing. For some reason I can't copy from that file. Okay. So let's say here, same as with indirect. And financing is also same as in indirect. And for cash flow indirect, I will just do screenshots from the guidance. Print screen. Okay, so investing activities is here. Later we will have to retype some of these. Let's go back here. It's quite a few of activities. Okay, let's now let's now copy. Let's see, inventory guide. No, I don't need inventory guide. Okay, so here it is a list of operating cash flows based on direct method. So let's go here. Here's direct method. Unfortunately, no, the formatting is not quite good, but we will use it for now. So here is direct method. It assumes we can identify any cash transaction and classify it into our operating cash flows. Like if we have just a few transactions, we can actually do that. But what if we have transactions from different entities consolidated in the single big entity? In that situation, it becomes too complicated to use direct method. And in that case, we go and use indirect method, where we let's take a look at AMC example. in indirect method, we start with our income for the period, or in AMC case, it's net loss. Let's see, I still have some time. And then we adjust that net loss for some non-cash items like depreciation and amortization. Of course, we need to know what our non-cash items are. Deferred income tax, loss on extinguishment of debt, amortization of net discount premium or corporate borrowings. Please take a note that even though transactions with creditors are usually in cash flow from financing activities, like when you get the loan or repay the loan, your interest payments are a part of your operating activities. And so we start with net income, we add back or deduct all non-cash incomes and expenses, and then we also adjust for receivables. So let's see what we have in the lecture on that topic. So we covered where we will show the items for these. So cash flow statements. In general, differences between net income and cash flow from operations are captured in operating current assets and operating current liability accounts. So that's where receivables, accounts payable, and accounts receivable will kick in. Think accrued salaries expense. If employees have not been paid for the last 3 days of the year, the journal entry made to recognize the salaries expense is debit wage expense, credit wage payable. Thus, to arrive at cash flow from operations, adjustments that need to be made to net income. Subtract net increase in operating current assets and other than cash itself. Add net increase in operating current liabilities. And also depreciation. So depreciation, as we might know, is a non-cash item. So when we incur depreciation expense, it doesn't mean that there was an impact on cash. And what is the cash consequences of recording depreciation expense? There is no cash consequences for depreciation expense. Say we buy PP&E for 10 million at the beginning of the year and estimating life is 10 years. And depreciated method straight line, so depreciation expense every year 10 million and minus 1 million. So okay, so depreciation, let's go back. We figured out that we have direct method and indirect method. Let's now do some a bit of a practice just to improve the understanding. We have transaction list. I wanted to do it on our third lesson, but I see I need to do it close, like almost at the same time while I am giving the lecture. Okay, so where are my cash flows? Okay, so our old transactions from the first lessons. 100K funds. So I will do all of that manually now, but at some point we will make all of that with the formulas. But now let's take a look at a couple of transactions one by one. So first transaction, we invested funds into business. We debited cash. Let me see why something is filtered here, but I don't see where. Select all. Okay, so cash equity. This is clearly a financing transaction. So we acquired, we get into transaction with the owners of the company, and that is definition of financing transaction. And or if we get in transaction with a bank, that's also a financing transaction. So we will have here direct, indirect method, owner, so basically it comes from here. Okay. So we have just increased our cash by 100K. Let's see what header do we have here. Net increase in cash equivalents and restricted cash. And let's put it here. So on the indirect, it will be all the same as here. I will not do double work. Oh, let's see if I can do it easily by just copying 17. No, not really. But basically indirect will be same as direct. So cash. So we got that cash. I will work in direct so far. Net increase. So we will say total financing. To maintain the structure, and total and total investing. Net increase in cash and cash equivalents will be the sum of all three totals. Okay. Let's do some formatting here. Okay, so what do we have on our transaction? We acquired a building with 50,000 cash, and we also got a mortgage of 150,000, and the cost of the building is 200K. Here it is a bit of judgment required regarding, and a bit more information regarding how do we recognize the cash flows, and we will see details on that when we dive deeper into our guide. But so far, acquisition of your production assets or the assets which we will use, long-term assets in the business, is an investment activity. And that's obviously a cash outflow for you. So that's cash outflow. But you also got a borrowing. You borrowed money to acquire that property, and that's cash inflow. And that's cash inflow. Transactions list 150K. Okay. So why does my formula not work? Okay, total investing, I need to update. You see our net increase in cash and cash equivalents let me highlight it by yellow, is 50,000. If we go to transaction list, we will see that we got 100K here cash and we paid 100K here cash. And it's actually 50,000. But the way we present it, we kind of grossed up the acquisition of property and mortgage and mortgage. Okay, so let's see transaction number 3. Merchandise is acquired for $20,000 cash. So cash outflow and merchandise acquired. So for direct, up to this point, everything will be the same in the indirect method. Up to this point, everything should be the same in the indirect method. But what's about inventory? This is cash paid to employees and other suppliers. Let's call it cash paid to suppliers. And in our case, that will be 20,000 cash outflow. Okay, we paid cash to suppliers. And we need to make a total here. And we got only 30,000 cash left. Let's now go to indirect method. So for indirect method, let's see if I have something here. Adjustments. Okay, depreciation, amortization, impairment. I will just copy some basic adjustments here. Okay, and I will call it total operating cash flow. So how would we reflect, and I will also need net income. How would I record that transaction under indirect method? So first of all, I have to look if that transaction has an impact on income statement. At this point, it doesn't have an impact on the income statement. So I record 0 in net income. I record 0 in net income. Then I looked if it has any non-cash impacts here. Let's see. Let's copy official descriptions of the line items. Okay, so no non-cash income, but it has an impact on balances, on changes in operating assets and operating liabilities. Okay. Inventory. So our inventory increased, and that's usually a cash outflow. So that would be a minus. Total operating cash flow. So you see, up to that point, so I remind you, investing and financing is the same between direct method and indirect method. The difference is in the presentation of operating cash flows. And so far in operating cash flow, we call it cash paid to suppliers. in indirect method of cash flows, we start with net income and we go to and make an adjustments. Okay, let's see. Do we have anything interesting left here? So that's what they call it, that we need to the differences between net income and cash flow from operations are captured in operating current asset and current operating liability accounts. And depreciation is a non-cash item. We will dive a bit further in that in our practice. So far we need to know that depreciation is a non-cash item, and on indirect statements of cash flows it adjusts the income. We can imagine a situation when we have only depreciation expense for the period, and we have a loss for the period because of that depreciation, but we have not lost cash in that case. Okay, that here they tell us how to record depreciation to arrive at cash flow from operation from net income, and we will practice that on our next video. We start with net income, add depreciation expense, subtract increases in operating non-cash current assets, and we add increases in operating current liabilities. We obtain cash flow from operations. So basically that's what we are going to practice here. And some gray areas. What do we do with interest expense and dividends? What to do with marketable securities? Start with net income, add depreciation, non-cash, increases in operating non-cash current assets, add increases in current liabilities, add any current non-cash expense, cash flow statements. So, and that's an example. So we start with net income, we adjust for depreciation, and we adjust for changes in accounts receivable and inventories. So we will practice that on our next lecture. Okay, I think at this point we are done with MIT lectures. I'm ending the stream now. Let me send you the link to the next stream. Where we will take a closer look at PwC guidance, and we will continue to practice our operating, investing, and financing cash flows, and we will also look into several pitfalls where an accountant who is not checking every transaction against the guidance can fall into. Okay, thanks everyone for coming, and see you in about 5-7 minutes. Thank you.